we're going to be recording the sessions, and we'll be able to send you out the recording. And my name is Nancy Philippi, and I am work in sales and marketing at Clients First, and some of you may know me. We wanted to bring you information on LeaseQuery. They're a new partner of ours. And just to start out, we're going to give you a quick introduction and some housekeeping. There's a questions pane and the GoToWebinar dashboard to send in questions. And there's also a place to download the presentation that Jason's going to be providing to you. There's some polling questions that we would love for you to respond to. Everybody loves polls. And then if you qualify for CPE credit certification, Kylie will be sending those out in the next week or so. So if you have any questions after today's webinar, you can contact us at the cpeinfo@leasequery.com to find out more about your CPE credits. And then at the end, you'll see Jason and my email address so that you can contact us if you have any questions. Jason is, a super smart guy. He's going to be doing our presentation today. He is a lead accounting manager at LeaseQuery, and he serves as a technical expert, which we all need, on the product and also the new lease accounting guidance, which has kind of caught everybody off guard. So Jason began his career as an external accountant or auditor at KPMG, and he's worked in many different industries. He's also a CPA for the state of Georgia, and has his bachelor's and master's degree in accounting from the University of Georgia. So Jason is the person that we definitely need to be speaking with today about the new lease requirements. So Jason, you want to go ahead and get started?
We certainly can. So what I will do is give everyone a quick agenda for our conversation today. And as Nancy mentioned, feel free to post questions in the GoToWebinar pane if you have any questions as we go throughout, whether we get to them on the broadcast today or we'll worst case follow up via email. But the first thing that we're going to go over briefly is just, hey, we've really already done this, but an understanding of our partnership with Clients First. LeaseQuery is happy to be partnered with such an organization. We're also going to cover the background on the lease accounting requirements so you all can understand why Clients First decided to partner with an organization like a LeaseQuery. And then the second piece of this is we're not going to go into too much detail, but we will talk through why it's not just setting up the accounting requirements for the new lease guidance. There are ongoing challenges that companies might face as they continue to account for their lease portfolio. So we're going to cover all of that for you today. So in terms of the partnership itself, LeaseQuery was founded about 11 years ago for the purpose of providing accounting compliance with the new lease accounting requirements. Now, there's new lease guidance for effectively any organization, whether it's a public or private entity, whether it's a governmental organization, or whether they are headquartered internationally. Now, we are located in Atlanta, Georgia. Clients First is obviously located in Dallas, but with remote work being such a central focal point for all businesses, we can make the partnership work, right? So in 2022, LeaseQuery, we have integrations developed with Acumatica, Microsoft Business Central, as well as Microsoft F&O, Finance and Operations customers. We've also seen from the Client First side, they have implemented ERP solutions for manufacturing, maintenance, repair and overhaul, as well as distribution industries. And you can see that Clients First is a gold Acumatica and Microsoft Dynamics ERP VAR, which stands for, of course, a value-added reseller. So we are happy at LeaseQuery to serve as a small but important piece alongside those larger ERP systems that you would utilize internally. And so just a little bit more background on LeaseQuery specifically. We've got around 2,400 customers today. We do retain just about all our clients when they reach their renewal period. And ultimately what we're doing is we are automating all of the accounting requirements related to an organization's lease portfolio. Again, whether it's a public or private entity, an international organization, or a state and local government. And with that, we can actually go ahead and launch that first polling question before we begin with some of the additional content.
So it might be a little soon for some questions from the audience, but Jason, I just wondered if you could lend some information or insight on if there's a number of leases prospective clients we need to have to get any benefit from the LeaseQuery suite of products.
Yes, I'm happy to do so. So the simple answer is if you have literally any amount of leases, we do offer a couple different versions of a LeaseQuery product to meet the needs of different volumes. But I would say overall, if your organization has double-digit leases, 10 and up, that is usually when investing in a technology probably makes sense, because you get to the point where you're tracking too many Excel spreadsheets that have too many moving parts to make it worth the effort. You'll also have to pull together a lot of financial statement disclosures at the end of the year. So roughly 10 is not only what we suggest, but most audit firms would suggest that if you have 10 or more, a LeaseQuery type technology would provide a worthwhile ROI.
Okay, that sounds like good information. Anybody that can help me with a spreadsheet, that would be greatly appreciated. All right, we'll close this polling question down in 3, 2, 1, and turn you back over to the presentation.
All right. So what we're going to do to start is give a background on what lease accounting even means and why organizations actually have to comply with the accounting guidance. And so what we're going to do is start by going over some very basic stuff. So like, what is a balance sheet? What is an income statement? The balance sheet on the left is a financial snapshot as of a point in time. So what you own, who you actually owe, and the value of the company. And it's always as of a specific date, typically at the end of the year, right? The income statement is actually a measurement over a period of time. So how much money did you make during a period? So typically a full year, you would see revenues that you make, subtracting out the expenses, and then that would give you the net profit that you would recognize in the period. So keep that in mind as we continue the conversation. So if we use a company like Delta, Delta's main purpose is obviously to fly individuals across the country, across the world, et cetera. And at any time, Delta is going to have hundreds of millions of outstanding lease commitments to pay for their fleet of planes, whether that's to Boeing or Airbus, et cetera. Under the old lease guidance from an accounting standpoint, you would have no idea that all of this money was owed by Delta just by looking at their balance sheet, because these contracts are typically structured as what's called an operating lease. Now, in an accounting world, the operating lease only impacts the income statement prior to the new lease guidance. So if we think back to what we looked at on the previous slide, if you have an operating lease, all you're going to do is showcase how much you paid for that lease in the income statement. So giving you a little bit better visual here, the expense was recorded where we have that orange highlight on the income statement, but on the balance sheet, there was no real trace of those operating leases to be found, because an operating lease by nature is an operating agreement, which originally was determined to not be worth showcasing as a capital obligation on the balance sheet. So we're only seeing this for whatever period of time is presented in the income statement. Now, although you could see the impact for the operating leases during whatever period you selected for the income statement, if you were looking at that liabilities line item in the balance sheet to show who you actually owe money to as of a specific date, there was no trace of those operating lease commitments on the balance sheet beforehand. And that might sound pretty dumb, and that's really why the boards have made changes to the accounting requirements. So we'll talk more about that in detail as we go on. But ultimately, you have organizations like Bank of America, Merrill Lynch. All of these are investment bank agencies that value organizations for investments, for stock market pricing, et cetera. And previously, from a leasing standpoint, not a whole lot of transparency in terms of what these organizations that have heavy lease portfolios actually owe. So a lot of these banks would actually reconstruct the financial statements of these companies to include those off-balance sheet operating lease arrangements in order to feel as if what they're looking at is more transparent. So if all of these investment agencies are actually reconstructing the financial profiles of these businesses, it might make sense to require these businesses to do that work themselves rather than make the investors have to go through that work. So what the problem was is not only that, but that all of these banks were doing it differently, and there was no consistency in terms of how you would recognize those operating leases in a projection forward. So the accounting boards decided that what makes the most sense is to author a uniform approach to account for leases that will not only increase transparency, but it will also create comparability amongst organizations. So you could look at one organization's financial statements as well as another's and know exactly how they compare specifically related to their lease portfolio. So that is what these three accounting guidance standards are. These are the terms that you would use to describe the new accounting standards. So on the left, ASC 842, the ASC stands for Accounting Standards Codification. That is for all entities headquartered in the U.S. that are either public or private in nature. So they would adopt the new standard ASC 842. The middle, IFRS 16, stands for the International Financial Reporting Standard. So you can imagine that standard is for any organization headquartered outside of the United States. And then the GASB 87 standard, that is the Governmental Accounting Standards Board. That is for all municipalities within the United States, so state and local governments. Just for a bonus bullet point, the federal government will actually have their own new lease guidance coming out in a couple years, but for the time being, we're just focusing on the state and local governments. But all of these new standards is going to create more transparency with the lease portfolio, which in the long run creates more confidence in the accuracy and completeness of market valuations. So that's an introduction here. So we will pause again and let everyone answer that second polling question.
So the second polling question we have here is, what stage of the lease implementation process is your organization in? And the choices we have here are the early stages of assessing the implementation. Possibly the project has just been initiated. And we also have an option for if you're in the process of evaluating and selecting your software. Possibly you're consolidating and collecting your lease accounting data. After that, the next option is deploying software and migrating your data to that software. And the last choice here is the lucky folks, where the implementation is complete. If your implementation is not complete, hopefully you're moving that way to make the end of the year deadline for private companies. And with that, we've given everyone the opportunity to respond to those polling questions. We'll go ahead and close this poll down in 3, 2, 1.
All righty. So continuing with the discussion on the new standards, one might ask who is actually responsible for writing the standards. So these are all of the governing bodies from an accounting perspective. So the Financial Accounting Standards Board on the left, They're responsible for authoring what's called a U.S. GAAP, which is United States Generally Accepted Accounting Principles. And that's for the ASC 842 standard. The IASB in the middle, International Accounting Standards Board, obviously responsible for IFRS, and the GASB is responsible for authoring the U.S. GAAP for governmental entities, so the Governmental Accounting Standards Boards. Now, who must comply with these standards? So as you can see, public companies as well as private and nonprofit entities are required to comply with ASC 842. Now, there are different deadlines for compliance. We'll talk about those in just a second. On the international side, any organization headquartered internationally, Spotify is a perfect example. They obviously have business done in the United States, but they are headquartered in Sweden. So they are actually under the IFRS 16 guidance at the consolidated level. And then you have state and local government accounting. They would comply with GASB 87. Now, the deadlines. So for a public company, publicly traded on a stock exchange in the United States, that deadline passed a while ago, actually. So they have been reporting under 842 since for fiscal years that began after December 15th, 2018. So if you're a public company and you have a calendar year end, you began adopting 842 as of January 1, 2019. So they've undergone a decent number of audits already under this guidance. Private companies, now that standard originally was designed to go into effect 1 year after the public company deadline. However, because of complexity with the public company adoption of this standard, private companies were offered a 1 year delay in their adoption. So it was initially pushed back to 12/15/2020. And then, of course, we went under a worldwide pandemic. The pandemic then gave everyone an additional year to adopt this standard. So now we have finally reached the point where after 12/15/2021, any fiscal year that begins would be under that 842 standard. So with that being said, all private companies that have a calendar year starting this past January will need to reflect ASC 842 in their financials. So we have now passed both of those reporting deadlines. IFRS 16, oddly enough, only had one deadline for both public and private entities, which was all periods that begin on or after January of 2019. So this aligned most likely with the public company adoption. For GASB 87, GASB also gave a delay of 18 months. The original adoption date mirrored the private company deadline, which would have been for all periods after 12/15/2020 or 2019. However, the 18-month delay allowed organizations to wait until fiscal years that begin after June 15th, 2021. So if you're a state and local government and you have a 6/30 year end, which is common within that municipality space, July 1st of 2021 would be the start period of when you would reflect GASB 87 in your financials. And we have already made it to that third polling question.
Sorry about that, guys. So our third polling question is, in the next 12 months, will the number of leases your company manages, and this is just your expectation, will they increase significantly, increase slightly, stay the same, reduce slightly, or even reduce significantly? And what we found here is we would have expected to see a number of increasing slightly or increasing significantly just based on going through your lease portfolio, trying to adhere to the new lease guidance. But what we're usually seeing is that stay about the same information. So we'll give everyone another couple of seconds to respond to this polling question. and go ahead and close it in 3, 2, 1.
Wonderful. So that gave everyone a good background on some of the initial reasons, not only why organizations are complying with these new accounting standards, but who actually authors those standards. And so what I wanted to do from here is give everyone a little bit more background. Again, we're not going to go into too much detail, but this will highlight areas of the accounting requirements, not only initially that are complex, but what might happen in the future. So first off, when we started talking about operating leases earlier, what we want to do is talk through what is actually changing when you adopt 842. So previously under ASC 840, you can see on the left side of the screen that there were capital leases and there were operating leases. Capital leases were always on the balance sheet. Operating leases were never on the balance sheet, as we mentioned. So now as we advance into 842, you'll notice that capital leases actually change terminology to a finance lease. However, it is just a nomenclature change. There's not really any required change from an accounting perspective. The big accounting change is on the bottom, where operating leases are still operating leases. However, there's a major change to how you account for those, because now these will be added to the balance sheet at present value. And then there's going to be some additional requirements subsequent to the adoption of the standard. Now, for the international accounting standard, this is actually different than what we just went over. So keep in mind that for the international old standard, which is referred to as IAS 17, there were similarly capital leases on the balance sheet and operating leases off the balance sheet. But as we advance into the new guidance, IFRS 16, the international accounting body decided that there was no need to differentiate anymore between what an operating agreement was and what a finance or capital lease is. So now IFRS has changed the name similarly from capital lease to finance lease. For those capital leases that were originally capital, similarly, there's no accounting change, just a nomenclature change, but the operating leases are now also going to be referenced as a finance lease. So you do not have to determine anymore whether a lease is operating or finance. If it's a lease, it automatically follows the finance lease guidance, where you would recognize an interest expense as well as a depreciation or amortization expense over time. So there is a pretty major difference between what an international organization has to do versus an organization underneath the US GAAP compliance requirements. And so reverting back to the US GAAP, this is what an amortization schedule would look like for US GAAP purposes. So that lease liability balance in the very middle of the schedule, that is the big balance that is now reflected on the balance sheet, which is the present value of all of those cash payments on the very far left. Now, to correspond with that liability in the middle, we go to the close to the far right, the second to last column on the right, which says net asset balance. On the bottom, it says ROU asset, which stands for the right of use asset. That is the corresponding asset that we would recognize adjacent to the liability balance. So those are the two new accounts we're recognizing. You're still going to see the income statement impact on the very far right, that total lease expense. That is going to be the same number every period. So you're going to evenly recognize expense over the term of the agreement, but there is a difference between how much you reduce your asset by in that second to last column and how much you reduce your liability by every period in the third column from the left. Now, rather than actually going into detail on how these are calculated, it is just simply worth pointing out that the complexity within these schedules is why organizations prefer to utilize a technology to automate this versus having to do this themselves in Excel. So that's why we set that up. As far as what the balance sheet will look like from here, you can see that the operating lease ROU asset, which we have a little bit of a like red highlight on the left-hand side showing where that is, that amount is separated from the property and equipment balance right above that. That property and equipment balance would include your capital leases or finance leases. The operating leases for US GAAP purposes will be separated out. So that's going to be its own line item. You'll have the operating lease liability on the bottom. And keep in mind that there are a couple accounts that existed under the 840 guidance that will be removed. Those are listed on the right-hand side of our slide. So underneath that asset, you'll see prepaid rent, deferred rent, and any unamortized lease incentive liability. If any of those accounts exist when you get to the transition to 842, all of those balances are simply absorbed into that operating lease ROU asset line item. So we're simplifying a little bit the presentation of this. It's all just going to bake into one account. And then you'll, of course, see that operating lease liability separated out on the bottom of the balance sheet underneath that liabilities and stockholders' equity section. Now, as far as financial statement disclosures, so we're going to give a summary of what organizations are required to disclose when they actually produce their financial statement footnotes. So as we go from top to bottom here, we do separate out disclosures for both finance and operating leases. And the information that is separated out for those is the following on the bottom. The amount of cash that is actually paid for amounts that are included in the measurement of the lease liability. And we would separate those out between operating cash flows and financing cash flows. So if you can recall, if you have a financing lease, there is a difference between the amount that is considered principal on the balance sheet and what cash reflects that versus the amount of cash that is reflected in interest. So those would be separated into their own cash flow sections. We also will showcase non-cash information like lease liability balances that actually arise within the period because you've recognized a new right to use asset. So really in plain English, that's just saying, hey, we're going to showcase the new asset values that you recognize in the period from establishing new leases. We also require calculations for weighted averages. These are a little bit more complex. So the weighted average remaining lease term, what we're trying to do is identify how much average term you have left in your lease portfolio per lease, but weighing more heavily the leases that are more expensive. So for example, if you have a lease that has 3 years remaining, but you're paying $1 million every month for that lease versus a lease that you have that has 30 years remaining, but you're only paying $300 a month for, your weighted average lease term will be much smaller because the vast majority of the money you owe for leases is going to be paid off in the near future. Now, similarly with the discount rate, we're going to do the same thing, but just identify what your average discount rate is, weighing it heavily on the more expensive leases. So those are the quantitative disclosures that are necessary separated out between your finance and operating leases. And there's a little bit more that is available here. And so this would give you an example of what the disclosure section will look like when you produce it in your footnotes. And it's pretty voluminous, right? And that's why we say any organization with 10 or more leases would probably want to take a look at software because the software is going to automate all of these schedules for you. You're going to have all of those lease costs at the top, all of the income statement amounts. If you happen to have any subleases, we will net that income against the remaining costs, and you can see that line item at the bottom. Then as we continue rolling down, you will also see gain or loss on sale leasebacks. You'll see the cash flow statement. You'll see those new asset values and all of those weighted average calculations. So this is the type of schedule that a system like LeaseQuery can provide, automating all those requirements for you. Now, day 2 accounting. So this is where we have a bullet list of items that make accounting for your leases a little bit more complex even after you set up those initial accounts. So the first is when we start thinking about lease amendments. So there are multiple types of amendments that can possibly take place based on the accounting guidance. So first is, have we increased either the amount of space in a real estate lease, or have we increased the number of assets in a master contract? If the space or the assets is paid for at its market value, that technically represents a new lease as opposed to an amendment to an existing lease. So there are complexities in just simply evaluating for that. Then as we continue through, a decrease in the ROU asset, so the exact opposite. So a reduction in the amount of space we're renting, or the reduction in the number of assets within a master contract, that would be referenced as a partial termination to the agreement. So the asset value and the liability are going to get adjusted at a percentage basis, and the variance in the dollar amounts of those reductions will be recognized as a gain or loss in the income statement on that partial termination. So that might be overly complex, but again, the idea here is that the software would automate all of these adjustments for you, so you don't have to worry about having to perform any of these calculations. Now, the third one is a more typical or common amendment where you are just simply changing the upcoming payment schedule, or you are changing the term length of the agreement. Those would be considered a true lease amendment, and you would revalue your liability and asset as of that day, and the asset is adjusted at the same dollar amount as the liability. So again, when you're amending an agreement, you have to determine whether one of those three categories is in line with the change and then adjust appropriately. Beyond that, these new ROU assets on the balance sheet, even though an ROU asset for an operating lease is technically intangible, you do still have to evaluate whether there is an impairment associated with the value of that ROU asset. So similarly to an organization evaluating their fixed assets for impairment periodically, you would now include the leases that you have the ability to use in that impairment evaluation. And if you do impair an operating lease ROU asset, the schedule that we looked at earlier actually changes, and the change is going to be centered around how you actually expense the lease going forward. So without going into too much detail there, just keep in mind that it's not just simply revaluing the asset, it's you having to completely change the way you recognize an expense down to zero on the asset, which adjusts the total amount of expense you recognize every period. Now, when you make any of these types of changes, that next bullet point, revaluing the classification of the lease, when we say that, we mean redetermining whether a lease qualifies as an operating lease or a finance lease. And then also to that is reevaluating the borrowing rate as well. So whenever you amend an agreement, you need to reflect a borrowing rate that is applicable within that specific period. Both of those requirements are relatively complex because the previous portion of your amortization schedule would use one rate, and then subsequent to that, you would be using a new rate. And if your classification changes, potentially a completely different account to recognize the lease expense. So when those scenarios take place, incessant complexity will arise. And again, having a software to automate this makes it a little bit easier. And then the last piece is a full termination. So a scenario where you purchase an asset or just simply early terminate in full a lease agreement that you have, you would need to calculate a gain or loss on that early termination when you remove your balance sheet items. And that would also require a relatively complex calculation and an adjustment to your income statement and balance sheet. So these are all just a few reasons why it's not just that initial setup of the accounting standard. It's also on a long go-forward basis, do we have the expertise on staff and the bandwidth to make sure that we are accounting for these leases appropriately? Now, with that, that will cover us for today's content. And so just a summary of what we have touched on for our presentation. We talked through the purpose and benefit of the partnership between LeaseQuery and Clients First Business Solution. We also have discussed our understanding of the nature of lease accounting requirements and what drove the change in financial reporting standards. Thirdly, we have talked about some of the quantitative complications that exist transitioning to these new lease accounting standards, but also beyond that, as we mentioned at the bottom, compliance complexities that go beyond just that initial transition. So getting started and the ongoing. What makes this so difficult to make it worth having an actual software do a lot of this work for you? So that's a summary of what we've talked about today. We also would like to extend an offer to everyone on the call today that we are willing to provide you a complimentary demonstration. And if you obtain or request that demo within 1 week from today, so by April 7th, we will award you with $500 off of your initial setup fee with LeaseQuery should you eventually choose to move forward. So no commitment necessary by simply requesting a complimentary demonstration. If you do move forward with a demonstration, you would be assigned an individual like myself at LeaseQuery who would walk you through the functionality of the product, provide you a little bit more insight into why the accounting guidance is important and how it's embedded within the tool and how it will help you all automate business processes. That's part of our demonstration process. And again, if you request that demo utilizing that link below or just shooting us an email within the next 7 days, you will have the opportunity to earn $500 off that setup fee for your organization. Now, we can go ahead and launch our fourth polling question, which will ask whether you have interest in obtaining that demonstration.
Very interesting information you shared, Jason. Thank you. As a salesperson, that was very helpful to understand, having more knowledge to explain it to our customers and prospects. So thank you very much. I hope everyone gained some knowledge from that presentation.
Absolutely.
And we'll go ahead and close that last polling question and turn you back over to wrap up the presentation with Nancy and Jason.
All right. So on my end, I would also like to thank everyone for joining us this afternoon or this morning, depending on your location. And as a reminder, you have the link within this last slide to schedule that complimentary demonstration. And if you do, within the next 7 days, you will have the opportunity to utilize that $500 off coupon with any setup fee associated with LeaseQuery. So once again, I appreciate everyone taking the time to join us today. And my email address is on this particular slide. So if you have any questions, feel free to reach out to me. But Nancy, I will let you go ahead and wrap us up for the afternoon.
Well, thank you, Jason. Really appreciate that information. I enjoyed it. So thank you very much for your time, and thank everyone for joining us. I'll send out the recording to our attendees in the next day or so. Okay. Thank you, everyone. Have a great afternoon.